Morning, everyone. It's here, man. It's finally happening. This is everything I've been talking about since early November. It first came to fruition with ARKK, the risk assets being taken down, taken all the way to the 200-week moving average and ultimately beyond. And now it's starting with the generals, the mega caps. So before we look at that, hey, take a look at this. I got a little account update note available here, and let me show you that's what that's about. This account was an account that I just used for tracking, and I got like $50 free because I referred somebody on it. And it's interesting, just proof for people who think I was bullshitting. Check this out. Um, I was more careful with this money than any other money I had, which is kind of crazy. Maybe I should do it reverse, right? Like, but the smaller amount of money I have, the more careful I am with it. Because if you make a mistake on $50, you're down to zero. So I've had this kind of challenge for myself to get this $50 to $10,000 one day. We're close to a 10 bagger at this point. But what I want to point out here is look how long and when I was out of the market from November all the way to just like last week, right? So this is what I've been preaching since early November: stay out of the market, out of the market. And I'm stepping my toe back in recently. Man, I wish I did this with my bigger money, but man, I can't afford to lose $50 because then I'll lose the challenge of $50 to 10,000. So we'll have this little annoying note up here because there's a day trade warning on there since it's below $25,000. Okay, so here we go. Man, this is it. This is the big week of earnings. Yesterday we had Microsoft and Google, and we have Apple Thursday. And look, I'm a lot different than all the other commentators out there. I'm not a technical trader. I'm not here to be reactionary and just trade what I see today. I'm here to try to predict things based on a holistic understanding of markets and individual stocks, based on our four pillars of fundamentals, catalyst, sentiment, and technical. So sometimes the predictions work, sometimes they don't. For the most part, I think we've been doing awesome. So I'm going to sit here and predict. And what I predicted earlier this week was that Microsoft would have great earnings, Google would have okay earnings, and Apple would have terrible earnings. And the logic behind that was simply linked to their exposure of discretionary consumer spending, right? Microsoft obviously is not discretionary consumer spending. They should not have any problems with their revenue. So was not surprised to see a nice beat out of Microsoft. Google does have some exposure to consumer discretionary, with revenue coming from Google search can be impacted by consumer discretionary. They sell Android phones, YouTube revenue, all of that has some consumer discretionary, but not as much as I think Apple will have. So that's why I predicted Google would be okay. Now, yesterday, I closed out my Apple puts that I've been talking about for some time. I made like 400% on those. I closed them out at the end of the day because I was hoping for a bear market rally for 2 days, based on Microsoft and Google earnings, great earnings and okay earnings. I thought, hey, you know what? The NASDAQ may go up for a couple days and I can reload on cheap Apple puts Thursday. That was my game plan. But Apple's down this morning. Google did worse than I thought, down 3.5%, with the headline numbers not looking great. So who knows? I may have to buy back the Apple puts a little bit higher. We'll see. But let's look at these charts real quick. Okay, I've been saying for a long time, QQQ, that we could see the 200-week moving average, and my target for that, I went up to 276 because that is a moving average, and you got to consider the impact of time, as it takes time for the market to correct, and this 200-week moving average moves up. You could see that, right? And there's a bit of congestion here and support in this level, while 270s to 280s. So my prediction has been this will settle down ultimately around here, maybe call it the 280s, but 276 to 280s. And look, that could take quarters to get there, as I've been saying since early November. But how would it get there? The only possible way it could get there is if you have some sort of disaster in Apple. So let's talk about that. Here we go. Here's Apple. Yesterday, after hours, it bounced off the 50-week moving average of 154. And you can see that red line has been a very strong supportive red line for years, multi-year support. It went down for what, a day or so, or a week here, below it and bounced back. And then here it tested that 200-week moving average. You can see repeatedly in all these charts I'm showing you, the 200-week moving average is the long-term bull trend line, which is another thing to keep in mind. Right here is the COVID high, 82. We're all here at 155. So in my perspective, you can't really call something a bear market or correction based on like 10% correction, 20% bear market. You really got to take that into context and look where it's coming from. So you can see, like visually at least here, I don't have numbers for you to how to define it in terms of percentage decline from the recent rise, but you can see that if this thing falls all the way back to $96, not saying it will right now, but if it does, it's still in a long-term bull channel, right? So people freaking out, like, so what, man? This is just a correction. At the end of the day, it's no freaking big deal. There's no reason why this shouldn't happen. If we go back and look at ARK, you can see all of the excess COVID liquidity has been taken out of ARK, right? Here's the COVID, pre-COVID high. Here's the COVID low. All of that liquidity has been taken out of the growth stocks, right? All that COVID excess. But why not yet out of the generals, out of Apple, Microsoft, Google? Well, we now see it happening, right? We see it happening with Netflix. We see it happening with Facebook. Now we see it happening with Google. Google's starting to look like a real correction there. Look, it doesn't look too far from the 200-week moving average now, right? So what's left? Apple. Okay, and Apple is $2.5 trillion. It's take a look at this. If you go to the Qs, you can see the breakdown. It's 12.5% of the QQQ. All right. So listen, my thesis has been out there. I've been on Wolf Financial Spaces, consistently repeating my bear thesis on why I think Apple will miss guidance this Thursday. If I'm wrong, I hope I'm wrong because I'm mostly long in my portfolio. But also, if I'm wrong, I think I just might be a little early. Let me see. I got 8 minutes. Maybe I'll run through it real quick. Like, why am I so bearish Apple? Okay, let me see if I can do it off the top of my head. Well, obviously, you have reduced sales to Russia and Ukraine. I also think you have depressed sales in all of Europe because of war sentiment and high inflation. Getting the latest gadget is not exactly top on your mind, especially if you live near the borders and you have millions of refugees coming in. I mean, you're in a war mentality. You're not thinking, let me have the latest technology, okay? Then, of course, you have Netflix warning, which I see as a sign of warning of consumer discretionary spend. By the way, I did a poll on our StoryTrading Twitter account about 6 weeks ago or so that, would you decrease because of inflation concerns? Are you considering decreasing your spend on Apple products? And 49%. 39% of people said yes. Okay. So I have some actually quantitative data on that. But listen, man, people forget a lot of people live paycheck to paycheck, millions of people. And when grocery bills are double, right? I always hear this argument, even on Bloomberg yesterday. You have these experts coming out, oh, the Apple ecosystem is so strong. People are not switching from Apple to Android. You forget Apple can have decreased revenue by people not upgrading their phones as quickly as usual. If they do it every 2 years, every 1 year, maybe they'll wait 3 years, right? That's a huge hit to revenue. Maybe they won't get the AirPods. Maybe they won't get the, extra, maybe they'll, I don't know, won't get other extra accessories, or they won't get an iPad or something like that. So lots and lots and lots of reasons aside from supply chain reasons. By the way, they're getting so stingy on insurance and replacing phones. They used to replace them so easily, and now they give you a very hard time over at the Apple store. They're no longer including chargers, no longer including earbuds in new purchases. So that's what I think. I think Apple is going to miss, and I think the Qs are going to be in for a big flush. If that happens, 316 was the prior low over here on the February 24th? I'm not sure where that. It was 316 was a prior low in after hours here. I don't know why it's not showing on this. It's a weekly chart, I guess. No, it's a daily, but trust me, it's 316 was a 52-week low. Last night it was well below 316 in after extended hours. And there's no way this does not, if Apple breaks the 50 DMA, look out below. Okay. It's going to be painful, really painful if that happens. And obviously, hate to say it, but that'll impact all of our stocks. It'll impact Kodak. It'll impact DRIO. It'll impact SMSI. It'll impact everything, right? Now, the way I'm personally playing it, you can play it however you want. I'm holding on to all those great stocks, okay? I don't trust myself to catch the bottom. I'm going to hold through the volatility. I do have a little bit of hedge on. I changed out my gold hedge to PSQ. Gold has not been working out. I don't think I have the reasons to get all of that. I left a detailed voice note in our WhatsApp rooms this morning of why I rotated out of my gold hedge into PSQ hedge earlier this week. Short summary of it is I think expectations for negative real yields getting more negative are now much lower, and that's the key ingredient you need to have higher gold prices. So actually, let's look at gold a little bit. Where is it? There it is. Okay, so it broke. It's a gap below the 50 DMA, negative real yields expected to get closer to zero rather than more negative, and that's why gold is underperforming. I rotated that into PSQ as my hedge. So, listen, you guys can play it the way you want to play it. You think you're a ninja trader and you can sell all your positions and get back in the bottom. Be my guest. Try to do that. Okay. I'm holding on to SMSI. I'm holding on to KODK. I'm holding on to CFVI, which has held up really well, actually. Very happy about the fundamentals and what's happening with the business over there. Of course, this will be prone to downside below 10 once the deal consummates. So we'll see what happens there. But for the meantime, $10 is the low. I just want to throw this out. Listen, stay away from DWAC. Especially, it's nail in the coffin, I think, with Elon Musk, but taking over Twitter. But it's interesting. Elon Musk tweeted about Truth Social early this morning that they're number one in the App Store now. And wow, that took me by surprise that he even has their eye on them. That's very interesting. I wonder why he mentioned them. Twitter is down 1%. Yesterday, they came out saying there's a $1 billion breakup fee to each party if anyone breaks up the deal. I don't know. Market's going down. Who knows? There's definitely a deal risk here, as you can see. Stock is down from 52 to 49. I'm still in the stock. I'm still selling covered calls weekly. I'll reload on those covered calls probably at the end of this week. I'll buy them back for 5 cents or whatever and sell next week's covered calls. But there's definitely deal risk here. This is a 6-month plus process. People worried about political ramifications, or the SEC or the White House putting pressure to maybe try to make sure this deal doesn't go. Market crashes. Elon can be like, hey, I'd rather lose $1 billion and pay $44 billion. So who knows what happens here? There's always risk everywhere. But I wonder if mentioning DWAC has anything to do with that. I don't know why I can't fix these interruptions in the share screen. Sorry about that. So CFVI was a Maria Bartiromo this morning. I didn't hear what was said, but I think DWAC and CFVI very different in relation to Twitter, where Twitter and DWAC are direct competitors, where CFVI can be complementary. And with Elon Musk at the helm of Twitter, I think that'll massively increase the exposure that Rumble can get on the Twitter platform. So I think it is very, very good. And of course, their cloud business may not do great if Truth Social eventually doesn't work out. But hey, in the meantime, with Elon mentioning Truth Social, who knows what's happening with DWAC? I would never touch this. I just monitor this in relation to any sentiment impact it can have on CFVI, which I have a large position in. So that was very interesting. Yesterday in the chat rooms, I did say I picked up a position in ARTW. It didn't work out yet. And I did that because technically it's lost all of its war gains, plus even before. You see this? This is not its war gains. This is its prior quarter that it jumped up from the prior quarter report, jumped up from the low 3s to about 4. And then these are the war gains here. It lost all of that after the earnings report came out. And demand is very strong. Backlog is at a record. The problem is they're having some issue fulfilling orders because supply chain issues and also hiring people. So that's why it's taken a hit. And I guess you can see downside to 270. But to me, at this point, downside of 270, maybe upside to 380, 370 to 380. 200 DMA is at 380. The 50-week DMA is at about 374. So I entered a position yesterday. What was the catalyst? I did that because Archer Daniels, as we covered yesterday, had a great report, and I thought that could light a fire under the ag sector. It did kind of throughout the day, but also Moss and IPI turned around, had great days. A lot of ag stocks did well yesterday. But towards the end of the day, Archer Daniels did not do as well as the other one we covered yesterday, which is the call, Arch and BTU. Arch maintained a 20% gain by the end of the day, and it's up this morning. BTU, the sympathy play, which Paul gave us in a room, also gave us Arch, is up 2.67%. I actually added some BTU to my portfolio yesterday. And so that's worked out well. But let's see if we can get some continued tailwinds in the ag sector, and maybe we can get ARTW to pop up here. There's a 200 DMA to 350, 380. Hopefully that'll work out, but we'll see. I held that overnight. PTHRF, I don't know a lot about it. New name to our community. Someone mentioned there was a webinar yesterday. This is an oil exploration company. I tuned in to some of the webinar. It seemed very impressive. I popped in for some. 1.14 billion market cap company. I don't have a lot of oil exposure at all right now. From all those war plays, I ended up closing out most of those hedges, war hedges, those new fangs. So, I have a little bit of money to get some exposure in oil. So I got into PTHRF a little bit. We'll see how that goes. DRIO Health, we are interviewing the CEO today at 3 p.m. Eastern. This is going to be an important interview. I convinced the CEO to do this as a private event so we can have a more open conversation. Obviously, we're not getting anything material inside info, but it's a more casual conversation where we can get more color and insight into the company's thinking longer term. The whole reason I called this meeting for Dario is because I asked him what his plans are to avoid dilutive financing over the next 2 years. Because of my concerns about the market. I am concerned that we could see something in the NASDAQ and the RQ similar to what the dot-com bust was, which was something it took several quarters, actually 2 years to find the bottom and 17 years to regain the highs. I'm worried that we could see that in sectors of the market, especially like the ARKK and the growth stock. So I'm like, hey, and non-profitable companies, I'm like, hey, Erez, it's not a great environment. If you have to raise money sometime in the next 2 years, you can get into some trouble. What's your plan to avoid that? That's what I asked him. I liked what I heard, so I invited him to speak to us today at 3 p.m. Eastern so we can get into his mind about his plans over the next 2 years of how he hopes to avoid dilutive financing. So that is not going to go on YouTube. If you're a VIP member, I urge you to hop on and from the CEO of Dario Health, Erez Raphael. And I apologize for always looking down. My phone's down here. Got to look down to see the screen. Well, I guess I could look it up. A little hard to do that, and then the camera's above the monitor. So in any case, not much else to say here. Nothing really material in the news feeds. Hey, I'm long Kodak. I'm holding Kodak. I realize there's downside here. It can go to 5. It could go to 507. It probably will. I am now psychologically prepared for this thing to hit 5 or 507 on Friday or Monday if Apple misses. But I'm not going to sell it. I love our due diligence. I have extremely high confidence and conviction in all the due diligence we've done. And I'm just going to weather the storm. And I expect to make a lot of money in Kodak over the coming quarters, maybe sooner, maybe weeks, maybe months, maybe days. They have their earnings report coming out in 3 weeks. Will they have their coming out party? Will they finally announce publicly all these great initiatives? They're having all these new job hirings every day. Actually, got to check Kodak.com. I didn't do it this morning to see if they have new hires, but they listed 7 new EV battery jobs on Friday. So things are going great there after the 2.7 million open market purchase by the director. And I will weather the storm, knowing full well this thing can definitely have very tough days ahead of it if Apple misses. So just be aware of what could be coming, guys, and you can play it like you'd like. I'll see everyone at 3 p.m. Eastern with the CEO of Dario. Thank you, everyone.